Warren, markets and borrowers have been pinning their hopes, not on a rate cut, but a series of them. You're calling 3 rises to the interest rate this year. That's a lot of people, I guess, hoping that you're wrong.
Yeah, and I sort of hope I'm wrong too, because there is a lot of pressure in our community, particularly with people with big mortgages or people who've just entered the market. But the RBA has to adjust that interest rate to make sure the overall economy is in the right spot, and of course, at the moment, to get that inflation down, to get that cost of living crisis behind us. And it's just the way my models and the way my analysis is shaping up is that it looks like the RBA pulling up short of other central banks at 4.35%. There's a real risk that it just won't get the job done. We need to get rates up just a little bit higher if we want to be completely confident that inflation is going all the way down. And the reason is that we're starting to see some better signs in the economy this year. It's still early days and this is just a forecast, but I'm concerned that by the time we get to that August board meeting, we may have the evidence that the economy is actually growing a bit too strongly for them.
We have had some evidence that suggests a slowdown, though. For example, the worst retail data this week since the pandemic. It seems it's be hard for retail to get much worse, really. So do you think the RBA is prepared to see the economy crushed here?
No, and they're not, and that's really what this whole narrow path is about, because you look at history, very few instances of any economy getting rid of a big inflation shock like we've had without a recession. We're trying to pull that off with this extended soft landing. And of course, that weak retail trade number for March, which there is no two ways about it, was soft. If that continues, I don't think there will be a case for a rate hike, because that's sort of what we need to see. We need to see demand soft in the economy right through this year, and that'll take that pressure off inflation, because bottom line is businesses won't be able to pass on cost pressures into a weak economy. So I would I would need to see retail improve over the next few months if we ever want to start talking about a rate hike.
The RBA is on the record saying it wants to see unemployment go to the mid-4s. That's obviously going to be a lot of people out of work. Is that what needs to happen before the RBA's work is done on inflation?
Look, I'm not sure it requires people out of work. I think we can get to 4.5 on unemployment over the next year or so with just not much job growth, because we've got such big population growth at the moment that you don't actually need to destroy jobs. And of course, that's actually what the recession story is all about. That's where you bring in the sort of the bad recession outcome when you're seeing big job losses and big falls in employment. You can get unemployment up to 4.5 by just stalling the jobs market for a period of a year or so. And I think that's what they have in mind. And at the moment, it just doesn't look like that's happening. We've averaged 25,000 new jobs a month in the first 3 months of 2024 so far, a lot of them full-time. And of course, that's well above our long-run average of about 17,000 a month for the last 20 years. So we've actually got a strong jobs market, and despite the big pickup in population, unemployment's still under 4. So that's one of the key factors that I'm worried about, that they may not have the job done on rates.
When considering, your call for 3 hikes, how does data that shows a significant increase in small business insolvencies and late payments weigh into that call? Because they're all indicators of a spluttering economy.
Yeah, and that's really what's going on after a long period of low interest rates, and then this amazing turnaround, which is not great, with inflation coming through and rates going up a lot. It's caught a lot of businesses and households out. They just weren't expecting in any way, shape or form rates to go from, the cash rate to go from 0 to 4 or 5 in a few years. But the numbers are still relatively small. So at the moment, first-time insolvencies, according to ASIC, are running at about a 12,000 annual pace, back to where it was in the middle of last decade. But keep in mind that we have about 2.6 million businesses in Australia. So the percentages are very, very low. So this is isolated pockets of extreme financial distress, and it's in business and it's also in households. But of course, the RBA is looking at the overall economy. And at the moment, those isolated pockets of distress are actually contrasting some very strong balance sheets in both the household and business sector, and an overall economy that's holding together pretty well.
When it comes to households, I guess those with a mortgage and renters are some of those feeling it the most. But there are some big winners in the property market. What impact would another 3 rate hikes have on home prices?
They have to have an impact, and a negative impact, I would think, because there is this undersupply story. This is I think, one of the major economic challenges for our community in the next few years. And that will mean that house prices will stay expensive. There'll be a demand, it'll keep it there. But if they do end up having to raise rates 2 or 3 times this year, I can't see how that's not going to push the market backwards for a short period of time. And of course, some markets will do better than others. I think Queensland, Western Australia are looking pretty resilient. South Australia is not bad. New South Wales, Victoria are soft. So yes, rate hikes will, I think, put house prices on a downward trajectory, but I'm thinking sort of a 5% fall, and that's only just taking us back to where we were late last year. So it's not going to really derail household balance sheets or the economy.
Our neighbour New Zealand appears to be sliding deep into recession. If we find ourselves in a scenario where we've got higher rates, higher unemployment, lower spending and declining consumer confidence, that'll just send us down with New Zealand, wouldn't it?
Look, the RBA will be watching that closely, and of course we don't want to see a deep recession. I think New Zealand's sort of stagnating with inflation, and that's... they don't want to cut rates there because inflation's still too high, but their economy's not growing that much. They've had big falls in house prices as well, which we haven't. I don't think we need to go down that path. I think they've got slightly different issues there. But of course, if we look like we're going to see a 20% fall in house prices, unemployment going up to 5%, the RBA will be cutting quick smart. But I don't see that happening. Our economy is actually holding up pretty well.
Warren Hogan, thank you so much for your time.
Thanks, Rachel.